Before I proceed with the class for today, I just want to make a quick recap of what we did the last week. This is the segment that we will have today. We'll be dealing with Learning Unit 3, and I've got a few questions that we're going to do together. One question would include Learning Unit 2, simply because Learning Unit 1 is just typically theory. So Learning Unit 2, I've got a little bit of a question based on the medical aid, right? And we'll just do that one question. And from there, I'll just go through the theory in terms of Learning Unit 3. Okay. And that will be our work for today, and then we'll move forward. I just want to do this question with you. I've developed it during the week, and I just want us to actually tackle this question just to get if you guys understand. Obviously, I developed this question based on what we have on our content, but it's actually similar, but it's not exactly the same as the ones that we have in the book. But it's quite encouraged that you guys should just go do those exercises when you are done with the theory, so that you'll understand the content better. Right, let's start with question 1, where you need to calculate your normal tax liability. All right, if you are given these are the questions that are likely to come up in the multiple choice questions, whether in your assignment or in your exam. They're highly possible to can come up in your exam. So if you are given this and you're given 4 different answers, all right, if you're given this, they give you the taxable income and they want you to calculate the normal tax liability based on the amount given from you as your taxable income. So the first one is 210,000 Rand. So I'm not going to ask the class like averagely, so I'm just going to pick and you actually continue with giving me an answer or the process on how to get your answer. Okay. So the first one, basically, how you're going to arrive at the answer is going to be on number 1 up until number 5. Okay. So it's not going to be different. The difference, sorry, the process would be the same, but the answers will be different. All right. Number 1 is 210,000 Rand. And Lesego, can you please give us an answer on this one? And then I'll just pick up the next person to actually can give us the answer. But I can give you the answer probably for number 5. It's okay. Okay, give me the process. Okay, when you get this kind of a question, what do you do? Firstly, what comes into your mind when they say normal tax liability that you must calculate?
I think the first thing you do, you check you check on the income tax framework, I think,
The framework.
See yes, and check if what amount it falls under.
Okay.
And then
I just want to intervene there just slightly. I think you are quite confused about the tax tables and the framework. Okay.
Yes.
So, right, let me just give you a bit of a hint there. You need to look at your tax tables, not the tax frameworks. You look at this, and we've got how much? 210, right?
All right. That's the table I was talking about.
That's the table we're talking about. And then what do you do, pal? You can open the table on your side, it's fine, because I'll be showing everybody else on how you do your calculations.
Right.
Right. Everybody else must just open up their tables. That's the first indication, or that's the first step that you must do. Okay, pal, what do we do?
And then I think, isn't it on the question was, the first one was 210?
210, that's correct.
Right. So it will fall under the second one, right? And then we'll
okay, let me just go ahead of you. Okay, it will fall under the second category or the second line item, right? You can see 210,000 feet in between 205,901 to 321,600 Rand. So let's look at the adjustment in terms of the rates under the same tax group. All right. So basically, what you're gonna do, you'll say 37,062, right?
Yes.
062, and then you plus it, right? And then you say open brackets, and then you're going to look at 210,000 rands, and then you minus 205,900. Do you all agree? Look at the
Yes.
figure on that line item, the last figure, where it shows 37,062 plus 26 of taxable income above 205. So you'd say 210, and then you minus your 205. I think it's 900 if I'm not mistaken. And then you multiply that by, let's look at the rate factor there. And the rate on your tax tables, it will be 26%. Okay. You multiply this by 26%, right? Right, and then you continue. Say 210 minus 205 number. So you'd say, say 210, 1, 2, 3, and then you minus your 206. Sorry, 205. Minus 205, 900. And then you multiply that by 26, you divide it by 100. That's your 26%. Right, it gives me an amount of 1066. And then you plus it with 37062. Then you give you amount of 38128. So 38128, it will be what's called your tax liability. You all get the process?
Yes.
Right. You look at the tax table first, matching the taxable income that is actually given. So you're going to take that taxable income given, and then you minus by that last amount on that line item of the taxable income, and then you multiply that by the matching percentage, and then you plus it with your 3602. That means based on the income that you'll be earning as an employee, you'll be paying an amount. In this case, you'll be paying an amount of 38128. That is your tax liability for the whole year of assessment, meaning that for the whole 12 months period. Right. Since well, I gave you an indication. Let me see, Pal. You can come for the second one here. It's 300,000. What do you do?
You say 300,000 falls under the second category still, right?
Second category still, yeah.
And then you will it will be 37062, right?
37062, yes.
And then plus,
let me just write it down so that everybody can just see. Is that 37?
yes, 062
plus
open brackets.
Open bracket.
So what is the figure of the second one?
300,000.
Or the question. Okay, then I think it would be 300,000 minus 205,900
minus, okay, let me just do this, just a moment, let's do this. Right, I hope you can all see that now. Minus 205,900.
yes, times 26%.
Times 26%. That's very correct. Okay. So obviously your final figure will be after you'd say 300,000 minus 205, and then you multiply that by 26%. Then you add it back to 37062, and that will be your tax liability for the whole year.
Yes.
Okay. Thank you so much for that, Pal. Umoto, can you please give us this one, the third one, 500,000 rand? What do you do here?
That one should fall on the third category.
All right, she's saying that it will fall under the third. Is it third category?
Fourth. My apologies.
Fourth one.
Sorry.
So the fourth one. All right. Lead me towards the process. What do we do here?
I can't see properly. Can you just go back through that table again? I think my textbook is a bit. Can we go back to that text?
That's fine. I can open that for you. Just a moment. Let me open up the sharing part with you. Okay. Can you see the text tables now? It's here.
They said it's 500,000. Yeah,
yes, it's 500,000.
Fourth category. So we'll take 105,429 plus open brackets. 500,000 minus the 445,100 close brackets and multiply by 26%.
Multiply by 36%.
By 36%.
All right. Thank you so much for that, Omozo. Right. Let me see. It seems like you guys are getting comfortable with regards to these types of categories. Let's see what I can pick here to do.
No.
We're gonna jump the 700,000 and go to the 1 million. Mojabeng, Motsepedi. That's your turn.
Yes.
Please go through.
No, I just wanted to ask. I just joined. Where are you in that which chapter?
All right. We went back to refresh our memory on learning unit 2. And this is the question that I did myself. And then I just wanted us to actually go through that. Lesego, I think you've been in here for quite a bit of a time there. Please take a shot on this one.
Okay. For 700,000.
1.8 million.
1.8 million.
Yes.
For 1.8 million, the category will be under the last one.
The last one.
So
yes.
It's going to be 5596 464 plus
464.
Yes.
All right.
Plus 1.8 million.
Yes.
Plus 1.8 million.
1.8 million.
Yes.
Right.
I'm trying to get this right here.
Okay, please do take your time.
Plus
it's okay.
Plus 5%. Okay.
Plus.
So it's going to be 559464 plus open bracket 1.8 million times 45%.
Okay.
That's bracket.
All right. But
is that correct?
Not quite exactly, but you just missed out 110 there. You're supposed to say 1.8 million minus 1,577,300.
Yes, that's what I meant.
All right. Yeah.
1.8 million minus is minus 1,577,300.
Yes, and then you multiply that by 45%, and then you add it
and
back.
And then I multiply that by 45.
Yes, that's correct.
Yes.
All right. So everybody else is happy with this part. All right. Since, well, everybody's quite okay with learning unit 2 questions, basically that's your taxable income. They might give you what's called the taxable income, and they want you to calculate how much will be the tax liability. And that's where you need to go to your tax table and make those necessary adjustments. All right, let's go through the theory. We're just going to do one portion of this one, and then we'll move on to the theoretical part of the learning unit 3. Right, question 2 says that Pujimeso, it's 68 years old, and is married out of community of property to Lerato. We have 2 children under the age of 18. His wife and 2 children are dependents on his medical aid fund. They are not persons with a disability as defined. And Puji's taxable income amounted to 300,000 rand, and the employer contributed 16,000 rand to the medical aid fund for the full year. Puji paid the following medical expenses during the year. Contributions to a registered medical aid fund. Usually the registered medical aid fund, we're talking about your best med, your body tests, your discoveries and so forth, your fed health and so forth. Right, so the contributions to the registered medical aid for the full year is 36,000 rand, along with the hospital expenses, which is the qualified expenses not covered by the medical expense. This is basically what you take out of your own pocket, and you expend on it for your healthcare, obviously, reasons. Okay, and your pharmacy accounts, which is part of your medical expense, which is not covered by the medical aid as well, is 4,000 rand. That's when you go to over the counter. So the first one is when you go to the hospital and add for whatever the shortage it might be. Okay. Going further afield here, we have let's have a look at, okay, that's going to be our last question, but we'll do this when we're done with question. I just want us to look at A because B, C, and D are more similar. All right. So the question A says calculate my medical expense credit, assuming that, actually I copied this. Instead of that, George, it will be Puti, 66 years old, and is married out of community of property, and is married I think he's married for 4 years with 2 children who are no longer dependent on his medical aid. Right. So let's have a look at, let's take out this kind of question. Sorry, the first question says that calculate your Puti's medical tax credits. Anybody who wants to take a shot on this one? Right, Pearl, Do you have an idea on how you're going to? All right, guys, let me just be honest with you. These are the types of questions that you're going to find out in your exam. And there's no way you can write your tax exam without the medical aid question. So you need to be aware of that. And that doesn't really make much me happy because we did this the last week and I expected everybody actually to go through what we did, just to refresh your memory the last week. Okay, if you get this kind of a questions in the exam, remember the moment you start, you are consuming more time and you're losing more marks. So when you're faced up in an exam situation or an assignment situation question, that's where you need to act immediately. Do you get what I'm saying? You don't have time to go and page your books and stuff. I understand you guys will be writing at home and stuff like that. But the moment you go back to the book, you need to know the page number. You need to actually, probably you forgot the process on how can you arrive at an answer. But immediately when you page up the book, you must just refresh your memory to say, okay, I just missed out on one step. Let me just see on how it goes. That's basically what you need. And the other thing is, I'm concerned on how you guys wrote your assignment because I think part of your assignment was part of this.
I think it's going to be 309, like open brackets, 319.
319.
Yes, I think.
Okay. Where do you get the 319 from?
Isn't that the medical scheme tax credit standard numbers for calculations?
Or 300? Or you said 319?
Yes.
Okay. Let's see. I'm just gonna write it down. And I just like the fact that you're getting somewhere. 319.
Yes. And then
319.
okay, sorry. I think I made a mistake. Is it not 638? Because it says 638 per month for the taxpayer and plus 215 plus
215.
another, yes, plus another 215 because there's 2 children, right?
Because there are two kids.
Yes, 2
Okay.
dependents.
Right.
And then close brackets.
Okay.
times 12 months.
Times 12 months. No, your first step is very well okay. Okay, it's very well fine. So basically what you were supposed to say, maybe let's say, guys, 638 and then you divide it by 2, right? So the first and the second the first dependent being the husband and the wife, obviously they're going to be divided by 2 because we need to determine the split in between the 2, right? So I think it's 319 multiplied by 2. Okay, so this was pale.
Yes.
Right, so yeah, it's 319. You multiply that by 2, and you say, you open brackets, 319 multiplied by 2, and then you close the brackets and you plus it. You open the bracket and you say 215 multiplied by 2, okay, because it's 2 kids. If it's 1 kid as a dependent or as a second dependent, obviously you're going to say multiply by 1, and then you multiply that by 12, but all of them.
Right.
Okay, that's basically your medical tax credits. Right. So the medical scheme tax credit, you remember the formulas that I gave you with your 33.3%, and then you multiply by your A, you multiply by your B, you minus your C. That kind of a formula. It's there in your study guide. Okay. There's no need for you to actually go to the book. They told us you don't have to use the book. But Pearl, thank you so much for the first step because you did quite exceptionally well on that one. Okay. So basically, the wife and the husband will be 319, and then you multiply that because they're 2, right? So if the husband is divorced or single, so it will be only 319 multiplied by 1, and then you multiply that by 12, and then you look at the dependents if they're covered by the medical aid. So it's 319 multiplied by 2 multiplied by 12. It will give us a total of 7655. And then obviously you've got 2 kids, you'll say 215 multiplied by 2 multiplied by 12. And then you will have 5160. You add that together, it's part of your medical scheme tax credits. And then it will give you an amount of 12,815. Right. And then your second step would be your excess. Excess would be how much have I paid as a taxpayer towards my medical aid, and how much has or how much have I got from my employer as a fringe benefit? Right, quickly, let's have a look at the question as to how much would be the excess. Let me just bring you back on. Right, obviously, it's me, my wife, and I've got 2 children that are under 18. The assumption would be they are covered by the medical aid. All right, but the question was very specific to say that we are dependent on the medical aid fund. Right. So the question further says that none of us are people with a disability as defined, right? But my taxable income amounted to an amount of 300,000 rands, and my employer contributed 16,000 rand toward the medical aid for a full year. Okay, now I paid 36,000 rand. That's my access towards my medical aid contributions. Well, that's what I would be entitled to should I be admitted at the hospital. Give you this quickly. So your access will be 16,000 rand plus 36,000 rand, and then you minus. If you look at the formula there, you'll multiply it by, obviously it will depend as to, okay, I want you guys to clarify this. When you're dealing with the medical aid, let me say medical aid question, you need to understand there's only 2 things that differentiate that kind of a formula. It's either your dependents are living with a disability or they don't live with a disability. That's how the difference will just come up into the picture. There are 3. 1 and 2 are actually treated the same. The 4th one is actually that is different. Okay? Then you'd say minus, and then you open your brackets, and then you multiply that by 4, and then you multiply that by your medical scheme tax credit of 12,815. You know where that comes from, right? So obviously 16,000 plus 36,000 is lower than the results we got from 4 months, whereby 12,815, and then our access will be a 0. Right. So the other things that has to be taken into account there is your hospital expenses that are not covered by your medical aid, as well as your pharmacy accounts that are actually not covered by your medical aid. Some medical aid companies would say will cover you in hospital up to this extent. That's quite a limitation. It's called a limitation, basically. So should there be any extra amount that has to be paid, it will be out of your own pocket. Obviously, it will depend on what kind of condition you have, or probably on how you have stayed in the hospital. Pharmacy accounts. Some of the medical aids, they don't cover certain medical, medication, or it means medication rather. So you may find out yourself at the counter buying, let's say, I'm just giving an example, flu tablets, or the medication that you actually have to drink. We'll look at that one. So in this case, I've spent 4,000 rand on the pharmacy accounts, and I also spent 8,000 rand under the hospital expenses. Sometimes you may qualify to actually claim that back. You understand? Probably it was like, let me just give an example in the sense that it was an agency, was also an agency where you were not actually covered by them. Or I don't know what could be happening to your medical aid, and you're forced to actually can pay cash and claim it back from your medical aid company at a later stage. But the fact remains that you have paid that out of your own pocket. Okay, so let's look at how the recording has been processed. So we call them the qualifying expenses. Obviously, that will be your hospital where you have paid 8,000 rand, or the pharmacy where I have paid 4,000 rand. Okay, so what you're going to do is you're going to add your medical scheme tax credit, and along with those of your qualifying expenses, and then at the end you're going to take the taxable income. Our taxable income in this instance, I think, is about 300,000 rand, if I'm not mistaken. It's 300,000 rand, and according to the formula, we are obliged to take the 300,000 rand and then you multiply that by 33.3%. Okay, obviously we need to look at the difference as to how that has been treated, right? So our medical scheme tax credit are actually lower than our taxable income, and obviously will give us a nil result on that one. You remember last week when I told you that if you found out that under your medical scheme tax credit, you paid over, there's no way it can be carried forward to the next year of assessment. You understand? So same applies to if you've spent less on that one. At the end of the day, the results will actually be your nil. Plus, there's no way you can claim it back. There's no way it can be carried over to the next year of assessment. Okay. I want us to actually end this medical aid thing today, because you can see everybody else is just quite confused about it. Okay. So what I'll do is I'm going to ask you guys to, when you go home during the coming week, I want you to focus on the medical aid part. Read your theory, apply it more on your questions, and we'll do more questions in the. I'm just going to open it up for everybody. You understand? I want you to bring me more questions. You understand? Why is that treated this way? Why is the medical aid done this? Do you get what I mean? Why this and this? And those are the kind of questions that I expect from you. So I'm giving you the opportunity when you go home after the class. Please make sure that you spend plus minus 3 to 5 hours on your readings along with your attempt of your questions. Because I can see everybody else is just confused when it comes to this medical aid. It would look quite complicated at the beginning, but you will get through it. All right. So you go home, read, aside your questions, all right, or aside the part that gives you a confusion. And then when we meet next week, before we move on to learning unit 4, we will do the entire set with regards to the medical aid. Make sense? Because I can see you guys are comfortable on learning unit 1 with regards to your tax liability calculations being given the taxable income. But the medical aid part, that's where you guys are having a bit of a problem. And for you to solve your problem is by going home, you sit on your chair and work through your medical aid. Okay, I want you guys to actually do that simply because you're going to find this in your exam. There's no way. You will find a question based on medical aid in your exam, whether you like it or not. So once everybody, each and every one of you to be comfortable or confident enough when it comes to the medical aid question or medical aid issue. Okay, well, let's have a look at our learning unit 3. I've compiled this summary of notes. I know it's a summary on top of a summary, but I just made it a little bit of a piece so that it should be easier for everybody. All right. So you guys need to understand that it's important to study and apply the theory on what you have studied. Let me share this with you so that we'll be on the same page. Right. Learning unit 3 deals with your gross income as well as your exempt income. In commercial language, if you can see tax and accounting, they're more related. The only difference when it comes to the unrelation is the concept, or the jargons that they use in tax, or the jargons that I use in accounting. By what I mean by that is, when you calculate the taxable, remember this thing at the end of the day is about how much you earn and how much you pay and how much are you going to get as a refund from SARS. So the accounting will prepare the financial statement to determine how much the income the business has done, how much of the expenses have they paid, and how much are we going to get as a profit or as a loss. Okay, so the same applies to your income tax returns as an individual. At the end of the day, like now, everybody else is preparing their documentation to submit their returns towards SARS. They just need to know whether they owe SARS, or they're breaking even, or they are owed by SARS. But under your gross income and exempt income, we're dealing with the incomes that forms part of your gross income. So, but the legislation tells us that certain types of income are exempt from your taxation as per the Act, right? It's the Act that says no. These has to be included as part of your income, but we need to show that as your exempt. Actually, just showing the proof that this is part of my income, although they do qualify as part of your exemption. Right. Looking at the definition, we need to look at the resident. Before I go further there, this is one of the questions that you might expect in your exam. Okay. They might give you questions where you need to give us the exact definition of your gross income. Obviously, they're going to give you a lot that they're going to confuse you based on your point A, B, and C, A, B, C, and D, right? And you have to pick up the correct one on that one. So don't say I didn't say that. You should expect that as part of your multiple choice question. And then if it's not there, do not blame me. Don't say I said it's going to be compulsory to be in part of your answer, but I'm just giving you a tip, right? Let's look at the resident there. We're looking at the total amount in cash or otherwise received by or accrued to in favor of that resident. So which it has to be in or during the year of assessment, excluding the receipts or the accruals of your capital nature. Right. So in this module, we only focus on the residents than the non-residents. Okay. So obviously your tax liability is going to be based on the residents. Okay. Let's look at the requirements for the gross income. So you need to look at there must be a resident. This is your definition that I'm talking about, that it might be possible to be in your exam. There must be a resident. You have to identify that in terms of the number of days that that person has been in the country, right? There should be an amount in cash or otherwise, and it has to be in the year or the period of assessments. That's your 12 months process, or 12 months period, sorry. It should be received, or it should be due or accrued to the taxpayer, excluding the receipts or accrual of a capital nature. Right, looking at the definition of a resident here, we're looking at any natural person who is an ordinarily resident in the Republic, not as any time during the relevant year of assessment, ordinary resident in the public. The person must be physically present there in the Republic for a period of exceeding 91 days in aggregate during the relevant year of assessment, as well as the period prior, as well as far for a periods or periods exceeding 91 days. So what this means is, remember, when you do what's called travel, there are documentation that you need to submit to legalize you in whatever the country you will be visiting, okay, including your visa or your passport and probably your ID. I don't know, I've never traveled across anyway. So when you go there, I know they stamp your passport, which is validating the date when you cross, and they will validate it when you do come back. So should it happen that you let's say, for example, now you move to Nigeria, and obviously I'm just giving you an example because our laws in terms of tax, they probably differ with their laws in terms of the tax. So when you cross in there, or let me put it this way, if a person from Nigeria or Zimbabwe comes into the country, legally so, when they present their passport, obviously it's going to be stamped for validation, okay? And obviously that will be due to their returns as well. Should they be found out that they've been earning an income in South Africa and they've stayed here for 91 days, that would qualify you to fit under the definition of a resident. I hope that makes sense to you. Right, looking at the period or periods exceeding 91 days in aggregate during each year, each of the 5 years of assessment period during the year of assessment will repeat for a period of assessment exceeding 915 days in aggregate during those 5 years preceding that. Right, the other way they're going to look at if you've been in the country presently for a period exceeding 91 days in each year, that will legalize and qualifies you as a present resident in the country. So if they look in aggregate of 5 years and they found out that you've been in the country for more than 915 days. Remember, a year contains about 365 or 360. So if you've been in the country for about 915 days in aggregate during those preceding 5 years, that will also qualify you to be a resident. There could be a possible question under the multiple choice question based on this one. Okay, so just be careful on that one, but we'll do a few more questions on that one on how you determine if the person physically qualified to be present in our country. All right, so that person will be a resident with effect from the first day of that relevant year of assessment. The day shall include a part of the day. So what do they mean by that is, if you are in the country for, let's say today it's your 90 day, and then you decided to leave the country by tomorrow, by let's say 10 or 11 o'clock. They're not going to say that you've been in here half, you don't qualify. Basically, because of you've been here half, it's going to be regarded as a full day. So that would make it your present, that will make you present physically, being available in the country. Right. But that shall not include any day a person is strayed through the Republic between two places outside the Republic. And that person does not formally enter the Republic through a port of entry. This includes like multiple movements. Let's say you're moving from South Africa to New York and New York to the UK. You can't count that day because you've been on the movement space. Right. So the person who is a resident is physically outside of the Republic for continuous period for at least 380 days 4 days immediately after the day in which such person ceases to be physically present in the Republic. Such person shall be deemed to have not been reliable. I mean, it's 3 days. 3 days is quite a lot, as opposed to 91 days. The ordinary resident, you and I, we are probably the ordinary residents in South Africa. But let's look at what does it mean. It refers to where a person normally lives, where the person lives with a degree of permanence, where he or she normally resides apart from the temporary or occasional absence. So the case law, obviously, that's a matter. Does it even better, as I've told you about, if you're not happy about the circumstantial evidence that the SARS have. So the process with regards to our claim and all of those, we did that in actually part 1. All right. So where the person lives with a degree of permanence, you and I, we spend more time in this country, so we perform our daily lives in South Africa. Okay, we reside here, but mostly permanently, not on an occasional basis. So occasional basis in terms of the absence is you are in South Africa for 4 months. The next thing you are in New York for about 2 weeks, and then you come back. You stay here for about. We know those kind of people who do travel a lot. Okay, but the reality. But the fact means that you spend more days in South Africa, if I may put it that way. But let's look at the exclusion of the receipts and accrual of a capital nature, right? So the capital nature of income is determined using 2 broad types of your guidelines: subjective test and objective test. I don't expect you to actually understand that, and probably in exam, I've never seen an exam where they triggered you about the receipts or accruals of capital nature, because it's always confusing for the students. You need quite an intense of reading. So if you do have a textbook, for your own knowledge, you can actually visit that. Right. It refers to the intention. Subjective test refers to the intention of the taxpayer, which is measured by looking at his or her actions and reasons, as well as the fact of the case. Right. So that's when you are including your gross income as part of your capital or accrual capital natures. So you need this kind of but usually they don't bring it because it confuses a lot of students. It's not well clarified. But objective test, the objective test can be used when the intention of the taxpayer is not clear, or if SARS and taxpayer differ regarding the nature of the income, which include the period for which the asset was held, or whether the taxpayer was involved in similar transactions before. I would like to believe that they would look at issues of if there's an argument between the taxpayer and SARS, obviously there's going to be a production of documentation to say, I'm not your resident, because this proves that I've been in the country for 90 days or 80 days, whatever the date is. And SARS will actually come up with their own business to say, no, you have to pay tax because you have been in the country for quite a number of days that have forced you to actually pay your tax. Let's look at the specific inclusions on that. The dividends, we agree on the dividends that they form part of your income. Some they are exempt, but we'll look into that one. So fringe benefits and the amounts for services rendered are 3 for the specific inclusions in the gross income. Fringe benefit I've explained to you by giving an example that if you are a permanent employee of, let's say, UNISA, and what happened is they would agree on a certain percentage with regards to towards their medical aid. So what would happen is you find out that I do pay, let's say 40%, and they do pay 60% for the coverage. Well, the 60% that they pay, it falls under your fringe benefit. Okay, it's not a cash benefit because it doesn't come to the taxpayer, him or herself. It goes through to the registered medical aid company. Dividends, all dividends received by the taxpayer are included in the gross income, and fringe benefits are usually referred to, as I've mentioned, non-cash benefit contributed by the employees, by the employers, but do not constitute cash payments made. Right, so we're going to deal with the lending unit in the far future with regards to the fringe benefits. They detailed more there, okay? But that should be a simple and quite clear explanation when it comes to your fringe benefit, right? So it's confirmed that all fringe benefits will be included in your gross income. medical scheme contribution paid by the employer, the total contribution paid by the employer to taxpayers' medical aid fund on behalf of the taxpayers constituted fringe benefits. I just gave you an example now with regards to the share portion of 40 and 80%. It doesn't always have to be the 40 and 60 percentage in terms of that share partnership brings. It might be different. The amount of the distribution paid by the employer on behalf of the employee who is 65 years old will be taxable fringe benefit and will be included in the employee's gross income, right? We found out more that in South Africa, we believe in what's called special skills. Sometimes people, they're given what's called an independent contract simply because of nobody can beat them with the skills that they have, okay? It goes further beyond benefits where the company can pay the fringe benefit on behalf of the taxpayer. What I'm trying to say is, if you look at a retirement age in the country, I think it will differ based on our gender in terms of male and female. Some are 60, some are 65. But some firms, they believe in appointing people that are over 65 simply because they need that special skills from them. Okay. However, it's going to be included in the taxpayer's gross benefit. When an employee has retired from the employer of such employer, irrespective of the age, I think I've explained that before. But the amounts of the service rendered, all the amounts received for the service rendered, whether capital or revenue in nature, will be included in your gross income. Okay, they are included in your gross income. The reason being, they would be exempt. You just show them that this is proof. But the second line items in terms of the taxable income framework, it will be your exempt income. Right? So I'm still reiterating to say that when you're dealing with the taxable income for the taxpayer, the age is very important. Why is it important? Remember, we dealt with, remember the primary, secondary, and the tertiary rebates. It will help you to determine where does the taxpayer falls in terms of your primary, secondary, and tertiary. Okay? But remember, that's just to limit more tax by the taxpayer. So marriage types, what not many people know is that if you marry in community property, for example, you are actually getting more deeper into the consequences with your partner or your wife or your husband, right? So the types of marriage is very important because you need to know on how to calculate the taxable income in terms of different types of marriage, whether it's anti-nuptial or whether it's in community of property. Right, married in community of property income received accrued to a taxpayer is deemed to accrue portions, which includes the rental from the letting of fixed properties but remember, those are your other incomes that you should include under your gross income, but it will be determined as whether they are going to be exempt or not. Right. It's no coincidence that many people, they've got investments with their own financial institutions separately. Okay. It's no coincidence that people have got houses somewhere that they rent, they've got tenants. Okay. They've got cars that they are renting out and so forth and so forth. Looking at the foreign interest, this is where you invest abroad and then you earn interest based on what you are making out of your capital. The dividends, which the same applies to your interest received. It can be local, it can be foreign. Dividends can be local and it can also be foreign. Right. Taxpayer who is married in community of property, all investments, capital gains tax, and relating from the letting of fixed property forms part of the communal estates need to be apportioned between the spouses in equal amounts. That's 50%. Exactly what I've just explained now with regards to the type of marriage. In community of property, we all know it's 50-50. Okay. I would like us to actually go to, but no, now I'll tell you what the time is right to go to the study because I want us to have a look at this interest and dividends. That's explained quite well in your study guide. What capital gains tax? There's a separate chapter, like I've told you before. CGT. We're going. I think it's the last chapter in the content. We are going to deal with that one at the end of the what do you call it? The end of the learning units. Let's look at our exempt income. Income could be exempt if it was included in the gross income. What they're saying here is you're going to have all the list of your gross income, and then you're going to have a line item says exempt. So exempt meaning that the incomes that are under your gross income, they don't qualify to be taxed. You just put them there as a plus under your gross income, and then you're going to deduct them under your exempt income. South African interest paid to South African residents, interest received by South Africa is actually included in the gross income. Any person younger than the age of 65, the limitation is 23,800 rand. For example, if you received your interest, let's say it's 18,000 rands, okay? It's going to be deducted in full because the limit is 28,300 rand. Any person over the age of 65, they are limited to 34,500 rand. I think it'll be more on the example when you do it. Right, the exemptions does not apply to the interest received from a tax-free investments, okay? So there are types of investments when you are investing, okay? There are those that are tax attachable, and there are those that are tax-free investments. Okay, and it makes sense. I mean, we're dealing with tax here. So the dividends received from the local South African company, they are fully exempt. Let's look at the foreign dividends. I think somebody was asking me a question with regards to the dividends the last week. So foreign dividends means any amount that is paid or payable by a foreign company in respect to the shares in that foreign company where the amount is treated as a dividend or similar payment by that foreign company for the purpose of the laws relating to that one. It is no coincidence that we've got a lot of people who invest abroad. People who have got shares in Nigeria, Zimbabwe, America, Europe, and stuff like that. Usually they come out with the dividends. Should they be suitable to be paid out to the taxpayers? That should be included as part of your gross income. So you've got a tax on income on companies of the countries in which that foreign country has its place of its own effective place of management. So it's exactly the same thing in there. Don't be confused by this one simply because we're dealing with an individual tax, not a company tax, right? But I think it's just simply saying that when the companies are paying individuals, those kind of dividends, right? Bulletin 3, with the companies of the countries in which the foreign country is incorporated, formed, or established, where the country in which the foreign country has its place of effective management does not have any applicable laws related to the tax of the income. Here's the thing. You remember when I told you that South Africa has merged with a lot of countries where they're avoiding the system of the double tax agreement. Because they found it quite unfair that you get income from somewhere and they tax you out of the country, and when the income lands in the country for you, you're going to be taxed again. So that's what they're actually trying to avoid. The foreign dividend is included in the taxpayer's gross income, but it may qualify for full or partial exemption from the normal tax. I'll look up on that part. Foreign dividends received from the company listed on the JSE Limited. Foreign dividends received from a foreign company in which the individual hold at least 10% of their total equity shares and voting. I want everybody else to look at the screen that is displayed now. Ladies and gents, let's have a look at what's called a partial exemption when it comes to the foreign dividends. Okay. So there are two blocks in here, or two columns here, where it deals with your foreign dividends as well as your how they treat it, okay, in terms of tax. So it says that the foreign dividends distributed by a company listed on the JSE, right? So full exemption. Example, if the foreign dividends amount to an amount of 5,000 rand, taxable income calculations would be gross income, and then you exempt it from it. I need you guys to know that. Very important part of this when it comes to the dividends. And I think these would help that student was asking about the dividends. I know that it's a bit complicated at some point, but you need to make sure that you spend more time on that. Let's look at the foreign dividends received from a foreign company in which an individual holds at least 10% of their total equity shares and your voting rights. Let's look at how they treat the full exemption in terms of the tax. So it says the foreign dividends received with an amount of 5,000 rand, taxable income calculations, the gross income of 5,000 rand, and the exemption, it will be 5,000 rand. Okay. But I want you to look at the difference between the first part and the second part. The second part dealt with the JSE limitation, and the other one they deal with a person who's holding a 10% equity shares. And along with your voting rights. Okay, right. Foreign dividends, the other foreign dividends, which is exempt on the ratio of 25/45. Okay, example would be the foreign dividends received with an amount of 5,000 rand, taxable income calculations, gross income with an exemption of 5,000 multiplied by 25 divided by 45. And then obviously the exempt would qualify by the ratio of 25/45%. Okay, that includes other foreign dividends. That would exclude when somebody is holding the 10% equity in that foreign company for voting rights, or if the company is listed at the JSE. All right. Let me look at the ZMB note, where it says, if the question states the taxable portion of foreign dividend, the amount should be included in the final taxable income. Let's look at our locals. Domestic South African dividends received or accrued to taxpayer. Let's look at the tax treatment on that. South African dividends received an amount of 5,000 rand, and the taxable income is 5,000 rand, and the exemption is actually in full. All right. Here's the thing. You can see that there's a slight difference with regards to foreign dividends as opposed to South African dividends. I'm not sure on how can they quite examine you based on this kind of question. Okay. However, I think they would state whether it's an other dividend or the dividend qualify for that ratio of 25/45. Okay. So you just need to be careful when you deal with that kind of the foreign dividends or the local dividends. The local dividends is not that complicated. Let's have a look at this example. It says Rosetta is 25 years old, 25 years of age, and Rosetta is a South African resident and in the following investment for the 2021 year of assessment. The interest of 14,000, local South African dividends of 5,000 rand, and foreign dividend not fully exempt. So they say that you need to calculate the investment income of Rosetta, which it will be included in your tax tables. But let's have a look at how they do that. So when we talk or when we spoke of the gross income, you can see that all these incomes are included in there, including your interest, your local dividends, along with your foreign dividends. But let's look at the exempt and how they treat that in your tax. As I said before, the age plays an important role. Okay, interest, which is local, it's limited to 23,800. We did this just now. Okay, the person is under the age of 65. It's limited to an equal amount of 14,000 rands. Okay, it means that the interest is lower than 23,800 rand. For example, if this person was actually received an interest which is greater than 28,500 rand, the limit would be, we are going to deduct that 28,500 rand as an exemption. And the rest will be part of the income that has to be taxable. Local dividends is an amount of 5,000 rand. We did that just now. It's please note this page is down and please go through it. Okay, they're fully exempt. Foreign dividends, partial exemption. I think the key word will be the partial exemption, where you have to bring your thing 4,000 multiplied by 25 divided by 45. So everybody else is actually, you can all see that. Okay, let me bring my question that I've just developed to you now. Let's go through these questions. I'm going to go through it on your own. Obviously, I'm going to contribute more. All right. This question 3 says Nick Moore is 65 years old, 65 years of age, and married out of community of property to Ilana Stein. They have a 10-year-old child who is still at school. Neither Nick or any of his family members have a disability as defined. That part you need is very key. Right, Nick's wife and child are dependents on his medical aid. The following information relates to the year of assessment ending the 28th of February 2021. Okay, so tax is not like an accounting where you can pick up any year end. It's standard that your year end or the year of assessment will be the 28th or the 29th of February every year. Okay, meaning that your beginning of the year of assessment will always be on the 1st of March. Right, let's have a look at the other components there. We've got a salary of 350,000 rand with a bonus of 28. There's a local interest of 21,000 rand. And the foreign interest received is 4,000 rand. So I didn't mention whether it's a partial or what. Right. So the dividends received from South African companies Actually, they were received from South African companies. Let's see, and then I think I made a mistake there. Sorry about that. But Nick Moore contributed 60,000 rand towards the medical aid contributions. The qualifying medical expenses not refunded by the registered SLAP medical aid, it's 8,700. Provisional tax paid in respect of the current year of assessment of 9,000 rand. The employee tax deducted in the current year is 61,000 rand. The required part says that you need to calculate mixed mode taxable income for the 2021 year of assessment. That's at your end of February, the 28 or 29 of February 2021. And then also your B says calculate mixed mode net tax liability refund for the 2021 year of assessment. So the first question would require you to calculate or to list all of your incomes, and it would include your salary, your bonus, and your local interest, as well as your foreign interest received based on their matching amounts. Okay, based on the questions that we have read just to you now, my incomes included a salary of your list of income entailed your salaries, your bonus, your foreign interest, your local dividends, and sorry, your local interest along with your local dividends. But I think I made a bit of a mistake there, but we'll rectify that, is fine. 350,000 rand is for your salary, and 28,000 rand is for your bonus. Your foreign interest is 4,000 rand, and local interest is 21. Local dividends, I said local dividends of 60,000 rand. See, let's look at our exempts. What? So with I said the interest is limited to 23,800 rand. Therefore, 21,000 will be deductible in full. It means that because it's not greater than 28,300 rand, so it qualifies as a full exemption. Okay, so let's look at the dividends. They are fully exempted, and then that's what I'm saying, that I think I made a mistake up there. So your taxable income is 43,800 rand. So this is how it works in terms of the accounting system. Accounting system, you're going to have what's called your revenue. Obviously, your revenue will be determined by your sales, and then you've got what's called your sales returns and stuff when you get your net sales. And going further down, you're going to say you're determining what's called the cost of sales. That's your exempt, right? So you determine how much will be your cost of sales, and then you minus that from your sales, and then you get your gross profit. So here we get the taxable income of 43800. Right, let's get to the issue of the tax liability. As soon as you get this, you're going to look at what we did previously in learning into. You need to go and find your tax tables, right? So my tax tables, they meant, I'm not sure which line item was it, but I found 67,001 for, everybody should be familiar with this. And I said plus open brackets 438,000 minus 321,600. Then I multiply that by 31%, add it back. It gave me an amount of 106,018. Rebates, I mentioned there specifically that that is determined by what's called the age factor, because age factor determines whether you qualify for your primary, your secondary, along with your tertiary. The medical scheme fee tax credits, I think it's PAL that gave us this kind of a clarity before. It's 319 multiplied by 2 because it's him and the wife. Then you multiply that by 12. It's for 12 months period. And the kids will be, it's only one. It's 215 multiplied by 1 multiplied by 12. We can just say straight 215 multiplied by 12. It gave us an amount of 10236. Right. So I've noted down there and said depending on how many dependents are there or they are covered by the medical aid. Right. Going further, looking at the medical tax expense, the contribution 860,000 rand. I think that's where I made the mistake by saying foreign dividends with an amount of 60,000 rand. Okay. Obviously, it will go or it fall under a certain group. You remember that medical tax credits. So it will be multiplied by 4. Remember we standardized it by 10236, and then you're going to multiply that. You're continuing it basically, multiply by 4, and then you get 40944. Right, and we're looking at the other qualifying medical expenses, which is 8,700 rand, and then your taxable, it's standardized at a percentage of 7.5%, and then you're going to look at their taxable income that were given before, and you say 438,300, and then you multiply that by 7.5%. Again, with 32850. Okay, so basically that's how you show your medical aid calculations or treatment. But let's look at our net normal tax. Net normal tax will derive from this part. Okay, so our tax tables gave us an amount of 106,018, and then we look at the age factor in accordance with the rebate standard. So we only found out that the taxpayer qualifies for the primary, which is 14,958. It's standard. You don't have to think about that. You must just know it, or it's there in your study guide, right? And the tax credit in terms of the medical is 10236. So it's actually derived from 319, and then you multiply that by 2, and then you multiply that by 12. Deducting this from 106,018, let's see what you're having. Your net normal tax, that's part of an adjustment, 80824. You remember we had a provisional tax of 900 rand and the employee tax deduction with an amount of 61,000 rand, right? So determine that Nick actually is owing SARS 18924, right? It's not always the case where you guys are going to owe SARS, but SARS is going to owe you. What I'm trying to say is there's a process that has to be followed so that you'll be able to determine whether you owe them more than they owe you. So if there's a refund, obviously it's going to be paid towards your bank account in a specific due date. I'm not sure how long the turnaround time for their payouts. Okay, we bring everybody else back to the spit. Okay, that brings us to the end of our session for today.